AIM-listed Trident Royalties is a mining royalty and streaming company. We last spoke to the business a year ago when we were talking to the chief executive, Adam Davidson, about the company just bringing on its first revenue stream as well. It currently has 21 assets now in the mining sector across a number of commodities, 9 of which are producing cash flow. So Paul Smith is chairman. He joins us now on the line. Paul, it's a pleasure to be able to catch up with Trident again, because a lot of water has passed under the bridge over the last year or so, and it's becoming a really exciting story. I know you've done some deals recently, which I want to talk about in just a minute, but I want to begin, first of all, with a look at this business model and the idea of royalties. Explain what it is you're trying to achieve here for investors.
Well, I mean, first of all, what is a royalty? A royalty in the mining space is, your viewers will be familiar with, I think, certainly royalties over music rights. Really, it's the same principle. So a contract is signed and a fixed percentage of revenue is paid to the royalty holder over the life of the mine, based on whatever the prevailing price is and whatever's produced, essentially. So that's what you get. Now, as a business, in terms of from an investor's perspective, what we see increasing interest, particularly from generalist investors who want exposure to the mining space because they are concerned about inflation. They are interested in gaining exposure to the electrification, the decarbonisation of the economy, but they want to do it. They lack perhaps the expertise or the specialist knowledge or the risk appetite to own an individual miner. So what royalties give you is almost unlimited diversification potential to the underlying commodities and the underlying businesses. So if you're a miner, as an example, so Glencore has the most number of assets. So that's where my former employer, it has over 150 assets. The problem is when you actually have to manage the assets, it becomes too much. The largest, we have, as you say, 21 contracts, royalty contracts in place already. That's within 18 months. So with the royalty business, you get exposure to the underlying commodity on a diversified basis. Very, very quickly. It's cash generative because at Trident, for instance, we have over 20 million of revenues, but we have 4 full-time employees only. We could easily have 100 contracts and still have the same employee base. So you don't get that kind of cost inflation within the system that you get within mining, which is also becoming a big feature at the moment. Also, what you get with royalties is you get the exposure to the commodity on a diversified basis, but also you gain from optionality. So typically when these contracts are agreed, the life of mine the life of mine is very, very highly regulated. So a mine will come into operation on a very conservative basis in terms of its cost profile, in terms of its level of how long it will operate for. Reserves, everything is about reserves. But in addition to reserves, you have resources, which is the optionality. Now, typically those are converted into reserves over time. And the contracts, a royalty contract, may be agreed and priced off 10 years, but the mine, often you find the mine is still operating after 15, 20, 25 years. Some cases it's hundreds of years in the case of something like Collahuasi, the giant copper mine in Chile. So you benefit as a royalty holder into that optionality. So it's not just about the price, and it's not just about that you're not exposed to cost inflation. You also have that optionality for the life of mine and the level of production.
Okay, let's take a look at what you've got in terms of the stable at the moment, because as I said, you've built this business up at quite a rate over the last year. You're talking there about 21 assets, as I said, 9 of which are delivering cash flow at the moment. Whereabouts are they? What sort of assets have you got on the books, and what's your preferred way of measuring how you go about purchasing and the sort of assets you're looking at?
Very good question. Okay, so yeah, we've basically done essentially the business was listed just over 18 months ago. So we've essentially acquired an asset every month. Now, in terms of our what we aim to do essentially is to provide diversification. So we seek exposure to base metals, battery metals, and also precious metals. The sweet spot for us, to be frank, generally is in the battery and in the base metal space. Why is that? Principally because the big operators, the big royalty companies, the Franco-Nevadas, their focus is very much on precious. So they have a much lower cost of capital than we do. So we can't really compete at that end of the market, certainly not at the moment. So whereas base and battery metals, obviously everyone's also, battery metals are a very sort of flavor of the month a bit at the moment, but it's also, we find where we can also get the best return. So it's critical. This is essentially, it's akin to an asset management business, essentially. So we take capital essentially from shareholders or borrowing. We have a long-term borrowing facility with Macquarie in place. And we deploy that and we seek a return. And the return, obviously, that we get is critical to driving the cash flows. So we look for the cash flow return, and we also look for what's called the internal rate of return, so the IRR. So we target IRR, which is unlevered, so not benefiting from leverage, and post-tax, we target an internal rate of return of greater than 15%. So when we're doing deals, that's what we're looking for. So we've just dropped out of 2 processes for portfolios of assets because the price expectations were that these things were going to be priced at sort of 6-7%. That's not. There are businesses in the market that target those kind of returns. That's not what we look for. So and there are other opportunities. Our biggest constraint. I was going to say there's not a lack of opportunities out there in the space.
Sorry, just very quickly, when you buy in, do you pay a premium or do you get a discount because you are an investor and you're pumping money into the business?
Well, it depends on, typically a royalty, a lot of the royalties that we've bought are what I would call secondary, what you might call sort of secondhand, if you like. So they're not, we didn't write them. Someone else has bought these things. When mines are created, often the last piece of finance that will go in will be a royalty. And it'll be put in often by a geologist, perhaps, who staked the ground in the first instance, or it could be just we just actually put $2.5 million into a gold mine in California, actually, of all places, which is a restart. And again, that royalty, the $2.5 million that we put in there was what was required to get that was the last bit of finance to get that mine restarted. So again, it's to us, it depends on the profile, and again, we target a mix of. If it's already cash generative, it's going to be typically more expensive, but not always. Again, there's ways of we have a good track record of thinking outside the box and coming at things at angle with angles where you can actually maximize your value. But the key in this thing is to try to avoid auctions. Don't buy assets through auctions, because then you're going to struggle to get your 15%.
How is the cash flow developing now? You talk a little bit about your gold asset you just bought in California. We've touched on the lithium asset you've just acquired. So you're acquiring some really interesting, as you say, hot topic minerals at the moment. What about cash flow? Because clearly it's one thing getting into these assets. It's another thing developing cash flow along the way. How is the cash flow developing across the business?
Yeah, the challenge in setting this kind of business up from scratch, as we did, is to get cash flow, because the assets that you can typically most effectively target will be more in the development cycle. So really, what we focused on doing in the last if we'd had this conversation in November, I would have said this year we will have cash flow of $2.5, maybe $3 million, depending on what the prevailing underlying prices are. We acquired a portfolio, a gold offtake portfolio, nine producing assets in December. With that came cash flow on analyst numbers of around sort of between 18 and 22 million of free cash flow each year. So what that's given us now is so now if I look at the Temesis numbers, this is our broker, current broker, they're forecasting, I think, free cash flow from operations of about 16-17 million for 2022, and that will go up as so what we have now is what I think is a very neat combination of cash, so 9 cash generating assets at the moment, with Seduli, which is our gold asset in California, that's coming on stream in the first quarter. Also, another gold producer. So the cash flow is going to grow as we get into particularly. We've got the Mimbula copper asset in Zambia, so copper cobalt, that is in ramp up. That asset, the plan is to IPO that business. during 2022. That's when we put that contract in place. It was based off a 20 to 25,000 ton copper. The plan on that asset the current plan is underway to produce 50,000 tons. So that will start to produce more cash flow as well. And then really the inflection point for us in our cash flow, where we start to really kick in cash flow is from our development assets from the back end of 2023, including the Sonora asset that we've just signed an option over, and then Thacker Pass, which is our other big lithium project. So those two big North American lithium projects come on stream end of 2023 into 2024. And then again, you see cash flow, depending on what you think the lithium price is, broadly doubling from where it is at the moment. And of course, the game is to use that cash flow. I mean, we focus primarily on growth. As I say, if we can continue to deploy in excess of the 15%. That track record, by the way, of the team's execution on deals is significantly above the 15%. Depending on what price you use, it's more like it's in the sort of high 20s, low 30s%. So we see so many opportunities out there to deploy capital. So we're going to continue to use. The idea from here is we will use that cash flow. It gives us access to credit, which we've got in place. We can deploy that cash flow into buying more and more assets, getting more and more diversified, getting more and more optionality, more and more cash flow, and so it goes on.
I want to pick up on another point that's mentioned at the back end of last year. I think you started to talk about the possibility about delivering dividends for investors. Now, this changes the business from growth to income, and it provides a different form of sort of income for investors. Do you think that dividends are coming down the pipe this year? Do you anticipate that? Is the balance sheet strong enough, and is your business model right enough to deliver dividends as soon as that?
Well, yeah, I mean, I think what we have to do this year is to put in place a dividend policy, because I think that dividend policy is a critical ingredient of the whole capital allocation process. I think we need to be very clear with investors, even more clear now that we have the cash flow. What are we going to do with it, and what are we not going to do with it? Which is also important. So yeah, I think we've started the conversation with our investors and with potential investors about what a dividend policy would look like. But typically what we're thinking of putting in place, again, at the right moment. They're not going to do that. This is not going to be certainly in the first half of 2022. But it would be a percentage of cash flow. It would be a percentage of the previous preceding quarter's cash flow paid quarterly. That's kind of what we're thinking. And look, this business model ultimately can generate as a base dividend 25 to 30% of free cash flow. That's not where we are, Jeremy, because we want to grow the business, because as we grow the business, we get more diversified, we get more cash flow. The rating, our cost of equity comes down, which again makes us more competitive to keep redeploying capital. As our cost of capital comes down, cost of debt, cost of equity, as the share price goes up, then our ability, the opportunity set of what we can put money to work in opens up significantly. More optionality, more cash flow, all good for shareholders. And again, I can say I'm just under 2% shareholder. So dividends are important to me, but they have to be at the right level at the right time.
Let me just bring up a share price chart, because you'll be familiar with the pattern of this, because we've basically, this vertical line is the point at which we went into 2021. So this takes all of last year plus the odd couple of weeks we've seen so far in 2022, and it has, broadly speaking, gone sideways. You're around about 40 pence at the moment. What do you say to investors about where this is going? Clearly, if you're starting to pay dividends, then we're not necessarily expecting any further uplift in the share price. If, as we've seen, as you went into the back end of 2022 with some hefty gains up from something like around about 15 pence a share, ending the year all the way up at 39, I mean, that was a more than doubling in share price. So that was something you would expect from a company that is going to grow as you have. But if you start paying dividends, what about the share price? Clearly, you've got no control over it, but on the other hand, you want to deliver shareholder value.
No, absolutely. Not least as major shareholders ourselves. So, and look, but I look at the price. Not, I don't fixate on the price in terms of personal wealth or anything like that. The price is really well, I think to a certain extent, it tells you how good you're communicating a message. And so I think the first answer is we need to be better at communicating. We're looking at some stuff around that. You'll see on Friday, we've upgraded our broker to Stifel, which is, they are, one of the go-to brokers at this size of the market. That's sort of, 200 million to 1.5 billion. So that changes, but that's new. There'll be research coming out from them. We're also looking to widen the research coverage across other brokers. So we're talking to other I'm in London next week to discuss with coverage from other. So research is a key thing. I think also, we're also looking at a new target list for investors as well. Basically, look, this is an asset. It has, Trident has compelling valuation. Depending on your numbers, it's 0.5 to 0.6 times NAV, and it's got a cash flow yield of 10-12%. Basically, you don't often get those two combinations, but that is a function of really market size to an extent. As we get, if you look at any kind of regression analysis of how these types of businesses develop, as you get more contracts in place, the cost, you start to get the benefits of that diversification and that cash flow. I would say that we haven't really had the credit from the market that I would have expected, given the transformative nature of the transaction we did, gold in December, and then again yesterday. I mean, again, we announced a transaction yesterday that it's an option, but again, on Themis's numbers, this option at lithium price of 15,000 long term, the spot price of lithium today is 55,000, but at 15,000 long term, which I think is a reasonable consensus number, the value of that contract, if we execute it, is 6.5p a share. We didn't really get any kind of response yesterday. So whatever the value of an option is, it's not nothing, right? So, but again, look, we'll be out there, finding new investors, explaining the story, explaining the royalty story as well. I think for a lot of investors, particularly generalists, they're not sure what a royalty, why invest in a royalty, why invest in a royalty business? What is a royalty business? And of course, having been in this space for 9 years, as an investor, I think the royalty business is the way for investors to get exposure to this sector.
The only one thing I'd say, of course, is that this lithium deal, as good as it was, it came at a very torrid time for the markets overall. So I guess that when things settle down, perhaps maybe people may appreciate a little bit more about the true value of this. And of course, it's very frustrating.
I mean, you can't, as a management team, you cannot fixate on the share price. You have to. Our job is to do good deals, and then we have to, then we have to get the message out about the deals we've done. But as a small company, you face challenges. Because you're small. But that's the opportunity, right? As well.
Absolutely. And of course, that's exactly what investors want to buy into, the opportunity that's not yet priced in. So let's talk about where we go here in 2022, because if you carry on at the rate you acquired interest in businesses over 2021, we could be in a very different position at the back end of this year. What are you targeting as a senior board member to look at where you go in 2022?
Well, I mean, I think we want to keep doing what we're doing. So we have a process in place to select deals, as non-competitively as we can. We have a good process in terms of disciplined allocation of capital. There's a good dynamic, a fantastic dynamic within the team, basically, and it works. As I say, we have a team member in Perth and two team members in Europe and the CEOs in America. So basically, the team is working 24 hours a day to find new deals. So, and again, I think when you start out, you have to. It's even more difficult to convince investors. But now you can, like any fund manager or asset manager, you can look at the track record, and the track record is the best starting point for anyone in any business, and the track record is good. So we're going to keep doing what we're good at, which is finding good deals in the base and battery and potentially precious metals business. I think the focus, if we have a choice, again, you have to be somewhat opportunity driven in this. When you're acquiring these contracts. But I think the sweet spot still is base and battery metals. So we're looking at more portfolios there. So it's more secondary, but we're also looking at some primary. So I'm quite interested. There's not a. We have an offsite in the week after next, and we're going to distill the pipeline and see, if of our sort of 40 or 50 million of capital we have to deploy over the next, say, 12 months. Where do we, if we only have that capital, where would we put it? Where do we want to deploy it first? And again, I think there's we've also had a lot of approaches. I mean, capital constraint is an issue. We've had a lot of approaches, and we're having some discussions actively with private providers, basically family offices, who want exposure to this space as well. But so there's scope to do clever deals around. So we could buy an asset for 20 million, but actually our ticket would be 50% of that, 10 million. And then, but within that contract, we'd have a right to buy back the other 50% for an agreed return over a period of time. So we're looking at transaction, structures like that to basically make the most of our 40 or 50 million. Because what I want to do, again, I don't want to deploy the 40 or 50 million into one asset if I can. I'd rather put it into 4 assets. Why? Because it's more diversification, more cash flow, etc. So that's the plan. It's really another. I think we can easily double the number of contracts we have in place over the next 12 months.
Look, Paul, we'll have to leave it there, but thanks indeed for joining us. That's Paul Smith, Chairman of Trident Royalties. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.